Imagine waking up one morning and discovering that your money buys less than it did yesterday. Not because you spent too much, not because your salary fell, but because invisible forces are quietly eroding its value. No one told you, no headlines screamed it. Yet this is exactly what happens every time central banks make money cheap. This is the invisible cost of monetary ease. And if you think it's just numbers on a spreadsheet, think again. It touches your job, your savings, your retirement, and even the future of entire economies. Why does this matter right now? Over the past decade, central banks around the world have flooded markets with cheap money. Interest rates at historic lows, trillions printed, and debt growing faster than ever. On the surface, it looks harmless. Loans are cheap, mortgages are manageable, and asset prices, stocks, real estate, soar. Everyone smiles. But underneath, something strange is happening. Each injection of cheap money is like pouring sugar into a recipe. You can't taste it at first, but over time it changes everything. Money is not neutral. It carries consequences. And these consequences are invisible until they hit. Here's the story of how it works. Central banks set interest rates. Lower rates make borrowing cheaper. Companies borrow more. Governments borrow more. People buy more homes and cars. Spending rises. This is the easy money effect. More cash chasing goods and services, boosting short-term growth. But here's the twist most people miss. Cheap money doesn't just fuel spending, it distorts priorities. Companies take on debt not to innovate, but to survive. Investors chase higher yields in riskier places. Savings accounts barely earn a fraction of a percent. In 2020, for example, the Federal Reserve slashed rates to near zero. Within months, corporate debt hit record highs. Many of these companies weren't investing in the future. They were borrowing just to cover existing obligations. On paper, the economy looked stable. In reality, it was quietly stretched thin. Now, the uncomfortable numbers. When rates are low, the cost of debt drops. But the amount of debt often rises faster than the ability to repay. Imagine borrowing $100 at 2% interest. Sounds fine. But if you borrow $1,000 at the same 2%, suddenly the risk multiplies. Across the U.S. corporate sector alone, debt has risen from around $5 trillion in 2008 to over $11 trillion today. Global government debt? Over $90 trillion. More than the entire world produces in goods and services each year. And yet, interest payments feel cheap right now. That's the invisible trap. The moment rates rise, even a little, the math flips. Suddenly, what seemed manageable becomes crushing. The world loves the story of cheap money. Headlines celebrate rising stock markets. Homeownership rates climb. Everyone talks about recovery and growth. Reality is different. Low rates favor those who already have wealth. Stocks, real estate, bonds, they all inflate. Meanwhile, wages stagnate. For the average person, buying power quietly declines. Here's an irony. Monetary ease is supposed to help people, but often it amplifies inequality. Those with assets get richer. Those without are left chasing faster-moving prices. Low rates also encourage risk-taking. Investors pour money into speculative ventures, cryptocurrencies, leveraged buyouts, exotic financial products. It's exciting until it's not. Step back. What does this mean for the economy as a whole? The invisible cost is systemic. Misallocated resources, inflated asset bubbles, rising inequality, mounting debt. When reality strikes, whether a spike in rates, a recession, or a shock to global supply chains, the consequences can be severe. History is full of warnings. Japan's 1990 bubble, the 2008 financial crisis. Each time, easy money created temporary prosperity, followed by long-term pain. And today, central banks are trapped. Raising rates risks slowing economies. Keeping rates low risks inflating bubbles further. Every decision carries unseen costs, and the public rarely sees the trade-offs until it's too late. So what's the takeaway? Monetary ease isn't free. It has an invisible cost, hidden in numbers, in behaviors, and in future crises waiting to unfold. Next time you hear about cheap money, think beyond the headlines. Think about who benefits, who doesn't, and what might happen when the music stops. Because the real question isn't whether money is cheap. The question is, who will pay for it, and how will it feel when the bill arrives?